Almost the entire world has been brought to a standstill as countries shut themselves off from other nations in order to contain the spread of novel coronavirus pandemic. This has led to a financial turmoil across the world. It is expected that the world economy will degrow by approximately 1 to 2% in FY20, led by Europe, which is expected to degrow by approximately 5%. India is expected to grow by 1 to 3% versus the IMF's earlier forecast of 5.8%, provided the contagion control measures start showing effective results. The immediate response to such an environment is risk aversion, which has led to foreign institutional investors moving money out of the Indian debt markets to the dollar-backed assets. This has also resulted in a spike in the bond yields, affecting the debt markets across all categories. All this has happened when the Indian debt markets were already coping with multiple credit events. This is undoubtedly one of the darkest times for Indian debt markets. While it's human to get scared due to the uncertainty around the coronavirus pandemic, we shouldn't overlook that beyond this uncertainty, there lies a silver lining. Let us take a look at what's on the cards for debt markets and why debt mutual fund investors shouldn't get too anxious. Low inflation. Due to sharp fall in growth and demand all across the world, oil has taken a massive hit, falling from $65 per barrel to $27 per barrel. Given the slump in crude oil prices, sharp fall in consumption and falling economic growth, the core inflation is expected to fall to a range of -1% to 3% by October 2020. The food inflation is also expected to see a sharp fall, as supply of food is not likely to get impacted due to low impact of coronavirus in rural India. Due to inflation being low, RBI can more confidently focus on economic growth as its priority. Global central banks and RBI measures. With global central banks taking unprecedented steps to support their economies, RBI has committed to whatever it takes to prop up the Indian economy. From rate cuts to liquidity measures, RBI didn't leave any stone unturned to minimize the impact of coronavirus on the Indian economy. Overall, RBI has added Rs 3.74 trillion in liquidity to the money markets. All these measures will help to enhance liquidity, revive growth, and preserve financial stability. In addition, RBI has provided regulatory relaxations like a 3-month EMI moratorium and waiver on interest for working capital for 3 months in a bid to ease capital and cost woes at the ground level. Abundance of liquidity. Systemic liquidity is at an all-time high at Rs 3 lakh crores and is likely to move up to Rs 4.5 lakh crores by next quarter and is expected to remain in the range of approximately Rs 3 lakh crores for the entire year. Ample liquidity in the banking sector will ensure that banks don't turn back any interested borrowers, and in turn providing abundance of liquidity to the non-banking financial sector and the corporate sector to aid the overall economic growth. There are more reasons to be positive now, including elevated spreads. Recent sell-offs in debt markets had elevated yields of debt instruments in the range of 3 months to 10 years significantly. Based on surplus liquidity and impact of RBI actions being played out, these spreads have come down. This is one of the big opportunities right now for debt investors, as spreads may further narrow down, resulting in capital gains. Historically, markets have recovered sharply after such stress periods. During the global financial crisis back in 2008 and taper tantrum in 2013, yields had spiked across the curve. Consequently, with the spike in yields, the debt funds did temporarily underperform. But with the RBI getting into the action and economy recovering gradually, yields fell sharply post-policy response, resulting in big gains for debt funds. Therefore, we believe that this is an attractive opportunity for debt mutual fund investors as there is enough room for a bond rally from here. One may consider high-quality AAA-oriented portfolios with short to medium-term perspective and avoid incremental investments in funds with high exposure to credit risk. Additionally, the falling interest rates on traditional saving products makes some debt fund categories even more lucrative for investment. So stay calm and invest now to benefit from immediate opportunities on account of current widespread uncertainty, high spreads, and expected RBI and government actions. For more information, call 1800-270-7000 or visit adityabirlasunlifemf.com or contact your financial advisor today. A scheme of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.